Hello, I'm Erica Nicole, and you're rocking with Rooted and Rich. And today I want to talk about investing. Some of you guys might be scared of investing because it is sometimes scary to talk about things or to do things that you don't have a lot of familiarity with. But I'm here today to help you get started. And so I'm going to talk to you about the basics. What I'm talking about is not day trading, it's not crypto hype, it's not timing the market. It's talking about ownership and a long term strategy to building wealth. I know a lot of you guys might feel like I'm too young, or I don't have enough money, or um, I'm too broke, or I'm too old. It's too late for me. It's never too late to get started. Today is the best day to get started. And so I want to encourage you guys as I explain a little bit about investing. So, when we talk about investing, we are talking about ownership of a company. And so, investment is a stock, and you gain ownership in that company. And as that company grows, so does your stock in that company grow. One of the best and easiest ways to get started is to invest in your retirement plan through an employer sponsor plan. And I want to talk to you about this because I did not realize this was investing when I first got my first job out of college. I signed up for it. I asked my mom what percentage to put in, and she said 3%. But one of the best ways to invest in the stock market is through retirement investing because those are tax advantage accounts that you can put pre-tax dollars in that can cut down what your taxable income is and can save you money while also securing your future. So, what would I suggest? I would suggest that you sign up for the plan, first of all, that you set an amount that you want to put in every pay period. And when I think about amounts, I don't want you to think about a fixed amount like $25 or $50, even though that is good. I want you to think about a percentage. And the reason I want you to think about a percentage after you sign up is because as your income grows with a percentage, the amount of money you invest in grows. So as you put in $50,000 and you put in, let's say 10%, which is $5,000, then when you get to 60,000 or 75,000, you will be putting in 6,000, 60,000 at $60,000 and 7,500 at $75,000. So the amount of money over time would increase. Whereas if a fixed amount, it would never increase, and that could stifle your growth in the market. The other thing I would tell you is to not focus on the different types of account. I would start with just a pre-tax account. That's what I started with. I did a pre-tax account. This lowers your taxable income, and it's the easiest way to get started. You can do a Roth 401k. I currently now have switched to that, but don't worry about that. Just get started. What I will explain what the Roth 401k is. It's just post-tax dollars. So after your income has been taxed, then it will put the money into your retirement account. And when you go to withdraw the money, you would have already paid the taxes on the money, so you only pay taxes once. With a pre-tax account, that money is not taxed until you take it for withdrawal in retirement, and at that time you should be at a lower tax bracket, and so you shouldn't be taxed at at a high amount, but the money will eventually be taxed when you go to withdraw. The other thing I suggest with the retirement plan is to just do an age-based plan. Some of you guys might be investment savvy, but if you're here with Rooted and Rich and you're here to learn the basics, you're probably not. And so I would just say get a age-based plan. And what an age-based plan does is you put in your age. It says, oh, you'll retire in 2065 or 2070, and then it will diversify it as well as balances, so where, like, if you're 25, you have 90% stocks and 10% bonds and other investments. Or if you're closer to retirement, like 50 years old, you might have 60% in stock and 40% in bonds, so that the closer you get to the retirement, the less risky your portfolio is. And that's really important because when you're starting to take money out of your portfolio, you want to be in less risky things so that you won't lose as much money because you don't have as much time to build the money back. The next thing that I want to talk to you guys about, after you have set up your retirement account, you have set it up, you have added a percentage. I want you to think about increasing it every year. So each year, I want you to be adding a percentage. I want you to think about what you can do right now, even if that's 3%, like where I started. And I want you to add a percentage, because where you think you are, you might be better off. And so I want to implore you to just go ahead and add a percentage or two to that. And then I also, every year from now on, I want you to add maybe 1% or 2% up until you get around 15%. Because 15% is the sweet spot. That's the spot where you know that, hey, I am building some true wealth, where I'll have the money that I need in retirement to retire. And you guys, doing this can build you millions of dollars over the next 20, 30 years, 40 years. And so I implore you to get started as soon as you start having earned income, and as soon as you have an emergency fund of $1,500, knowing that you will build the 3 to 6 months emergency fund in conjunction with investing in your retirement. I also want you to think about debt repayment. So if you are like have a lot of high consumer debt, then I would implore you to lower your percentage and pay off that debt, or pause investing until you paid off that debt, because you want to be throwing most of your money into getting rid of that debt that you have, because at 29%, that's eating your wealth, and it's not allowing you to do much if you have credit card, or 20%, or however much the credit card interest rates are. So I want you to aggressively tack that as well. After a while, you though, guys, this will be really easy, because with the 401ks and the 403bs within your at your company, they are automated and they help you to pay yourself first. They take the money out before you ever get your check. The money's gone, and you will adjust and you will get used to it, and your future self will thank you. Some of you guys might be like, I'm already doing that. I've already hit 15%. Or, Erica, I have other goals and I don't want to wait to get to my money at 65 years old. I understand that, and I'm with you. And so there are other type of investing that you can do through a taxable brokerage account. And so usually you can set those up through Charles Schwab or Fidelity or Vanguard, or a number of other places where you can set up a brokerage account on your own. When you set this up, I want you to set this up not for your emergency fund, but for those medium term goals that you have. Meaning that in 10 years you want to buy a home, this is the perfect place to put the money. The money that you need, your 3 to 6 months emergency fund, should be in a high yield savings account, and you can use bankrate.com if you would like to set up that emergency account, and find a bank that has the best interest rate for you. I currently use Marcus by Goldman Sachs. But when it comes to investing, this is for your medium term goals. So this is not your emergency fund, and this is not your retirement account. What I want you to focus on primarily is index funds. Index funds are low costing funds that incorporate a number of businesses, and that helps you to diversify and also to lessen the risk. When you invest in an index fund, let's say the S&P 500, you get the top 500 companies, and when one of those companies go bankrupt, as sometimes companies do, another company pops to the top, and though the fund may dip, it doesn't go to zero. And so that is a sure way to make sure that you ride the market over time and not time the market. What I would tell you is that some of you guys are going to want to invest in individual stocks. You've heard of stock in individual companies that you want to invest in, and I will implore you to make that a smaller percentage of your portfolio. So maybe you have 90% in index funds and 10% in individual stocks. When it comes to individual stocks, like picking a business like Amazon or Walmart, or whatever company it may be, I want you to do your research. This is where you're going to look at that company's financials. You're going to look at what the products and services are. You're going to look at their strategy to see how they would maybe function in a recession. Are they recession proof? Will people still buy their products if there is a lot of layoffs and job loss? What is it that they sell? who do they market to, what is their business, and what is their long-term strategy. This is where I want you to do more of your research, because this is where you are taking the most risk. And so with risk, you want to have, there's high risk, high reward, but it also is a risk. And so I want you to do your research and be prepared. If you're not ready to do research or be prepared in that, then I would highly suggest index funds, where you can kind of set it and forget it over a long term period, and you can just ride the waves in the market instead of trying to beat the market. So, what I'll say when it comes to investing is this: you cannot build wealth without compounding interest. And so, you have to get started. I would start where it's simple, where it's simplest, which is with a retirement account through a employer sponsored retirement account. If you are unemployed or you're an entrepreneur, you can set up several different retirement accounts. Most common one is an IRA or a Roth IRA, through a Vanguard or Fidelity, and you can do the same thing I'm telling you. You can put a percentage of your money away, and you can have that money invested on a routine basis into those accounts. And so that may take you 30 minutes or less, and you can select the age-based plan within those, so you can do that even if your employer doesn't have a sponsor one. You can go through a Vanguard or Fidelity or a Charles Schwab to do that. The next thing I'll tell you is this: is that investing is not it's not fun. Index funds aren't fun. They're not exciting, but they build wealth over time. Retirement accounts, they're not exciting. It really feels like you're putting in drops in the bucket, but one day you look up and you have a six-figure account, and then the next day you look up and you have a half a million in that account, and the next day you look up and you have $1 million in that account 30 years later. And so what it takes to get you to $100,000 takes a quarter of the time to get to $500,000 or to double that money, because compounding interest working for you when all that money is stumbling over itself, and increasing over itself, takes less and less time. So I implore you to get started today, to don't wait to invest. The best time to start is today. And so don't put off what you can do today to tomorrow. Hey, Rooted and Rich fam. I wanted to come back and talk about ETFs just for a hot second. I didn't put that in the video, and that was a big miss on my part. But ETFs are exchange traded funds, and they are a basket of investments that trade just like a stock on the exchange market, and they follow an index as well. So think about an index. I talked about what that is multiple companies into one fund. An index fund is similar to that, but it trades like a stock instead of being traded once a day like a index fund. It is that are bought and sold once per day in the market's closing price. ETFs are sold and traded just like stocks, and they usually cost a lot less than most index funds because they're cheaper to operate. And so if you see a index fund like the S&P 500 and you want that ETF of that, you can also find that, and that might make it cheaper for you to get into the market, because a lot of those will start at $1 or $10 or something like that. Whereas if you did a certain index fund, it might cost you $3,000 to initially buy in, and then you could set like a reoccurring amount of $50 a month or whatever you want to do. I thought it was a big miss on my part not to talk about ETFs, because I know if you're researching investment, you are thinking about those. And so I definitely want to add that to this video. But I won't belabor the point. Let me know if you have questions or if you're invested in ETFs and your experience with them. But I definitely want to add that on. That is a great option if you're looking to invest for your midterm goals that are like 5 to 10 years out. Let me know in the comments if you have questions or if you want to continue the conversation. See you in the next video. Bye.